Welcome to the webinar. Today, our speaker, Mark Shone, who's the president and founder of Shone Wealth Management, will be guiding us through how to maximize your equity compensation and achieve your goals. Mark is responsible for all aspects of financial planning and asset management for his clients and has been working with clients for nearly 30 years. So he has a lot of experience speaking on guiding clients through topics such as retirement planning, preparing for the cost of education, investment allocation strategies, estate planning, and obviously equity compensation. So before we get started, I did want to handle some housekeeping items. We will have questions and answers at the end of the webinar. So if something comes to mind during the webinar, feel free to use your Zoom question chat box, and we'll be addressing as many questions as time allows. Additionally, all of the attendees from the webinar will also receive a follow-up email with a recording of the webinar and additional information on Shone Wealth Management. And with that, I will turn it over to our speaker, Mark Shone.
Great. Thanks so much, everyone, for joining this afternoon. Over the next 30 to 40 minutes, we're going to go through equity compensation and some of the key factors. So just to set the agenda here, we'll talk a little bit about how we got here, your professional success, the use of concentrated stock, go through the basics of equity compensation, and then we really want to put it into context on how you make decisions around what to do with that equity compensation, informing hold and sell decisions with the stock. And then we'll get into some real detailed strategies around managing those concentrated single stock positions and what are some of the things that people do to essentially turn equity compensation into cash, which is obviously pretty important. So let's just start with your professional success. So there's been an evolution in equity compensation. It used to be the case where it was just senior executives that had to deal with equity compensation issues. They're good issues, of course, but it was really to senior executives. So people who were more tenured, after decades of success in a firm, they started to receive compensation in the form of equity. That's changed a little bit. It actually comes to employees pretty early, and quite often in Silicon Valley, even entry-level positions receive some sort of equity. So what that creates is it creates an environment where you have to begin to make decisions. So you can't just be passively waiting for a check to hit your W-2. You actually have to take some action to convert that stock to compensation. So we'll jump in and get to the basics, really, of concentrated stock and the uses of the concentrated stock. So what is a concentrated stock position? So just some general terms there. So we typically look at it as any position that's greater than 10 or 20% of an overall portfolio is considered concentrated stock. And with the success of many of the technology companies, it pretty quickly can reach that level. The other way to think of this, the other framing, is the size of the individual portion that can negatively affect your financial plan. So as I was saying, stock really turns into cash flow, and you want to realize that compensation. So depending on the performance of the underlying stock, it's usually anywhere between 5 and 50% of that stock position that can have a negative effect on what you're trying to accomplish. What makes it risky? So we'll start with the negative side, and these aren't as fun to talk about, but obviously if you have a company that's invested and it goes bankrupt, you lose all your money, mismanagement falls out of favor, have heavy regulations, you can get underperformance in that stock. But just to give you a sense for concentrated stock or individual stock positions as a whole, traditionally the median individual stock is about 30% more volatile than a broad-based index like the Russell 3000, which is essentially all U.S. stocks from large companies to small companies. It's about 30% more volatile, and the actual median return is actually slightly less. So the risk return of an individual position isn't exactly optimal. Having said that, we do always wish for the stock to go up because that's going to help your long-term financial picture. But we want to manage that concentration, that volatility, and build that into an overall diversified portfolio over time. Let's look at the basics here. What is equity compensation? So what are we talking about? So it is a non-cash payment that represents ownership in a company. So it comes in a few different forms. One are performance-based shares, which usually come in the form of restricted stock. So there will be performance-based shares. There's general restricted stock that comes to you. We'll talk about vesting schedules and how that works in a little bit. And then there are options, and there are two forms of options that are typical. So non-qualified stock options and incentive stock options, which have very different tax ramifications and decision points that you have to make. So where they're used, they used to be used quite a bit for companies to make up of lack of cash flow in the startup world, but now it's become more really to attract high quality employees, and it's become a staple of employee compensation. It's very, very common. So let's dive into one of those types of plan, which is known as an employee stock purchase plan. So it is a company-run program that allows participating employees to purchase stock in a company at a discounted price. There are two different types of plans. There are qualified plans and there are non-qualified plans. In today's world, we're going to concentrate on the qualified plan because that's where we see things land most often. So they are definitely more common, and they're more common because there are tax benefits, and it also allows you to purchase stock at a discount. So just some of the things that have to happen. So there's certain eligibility criteria set by the IRS. They're approved by a vote of the shareholders before it can be executed. And then all employees have equal rights to that plan. And the offering periods are not allowed to exceed 27 months or the discount exceed 15%. So what is typical with these plans, those are kind of the outline factors. What's very, very typical are quarterly purchases, sometimes 6-month purchases with these plans. But at the long end, the 27-month period is the longest they can be to still be considered qualified plans. Non-qualified plans, just very quickly, they're less complex. They don't have tax advantages, and you have to pay taxes on the purchase date with those plans. So they are not very common. So I'll kind of leave that there for non-qualified plans. If anybody has those, it's something that can be addressed down the road. A majority of these are qualified plans. So how do you make a decision whether you want to participate in these? So it's really important to start with the end in mind, all right? So start at the end and say, what are you trying to accomplish? Are you trying to save money for short-term goals, intermediate-term goals, long-term goals? So start with the end in mind. That'll help you facilitate how much you should contribute. And the other thing to really understand is, even though you're getting a discount, over the long haul, the stock still has to perform well. So you need to ask yourself, would I buy this stock without an employee stock purchase plan? And you look at it in conjunction with other equity awards you may have, whether those are incentive stock options, non-qualified options, restricted stock that's about to come due. So you have to put it in context of certainly your goals, one, but you have to put it in context of how much you own in the stock in other arenas as well. So the implications, tax implications of employee stock purchase plans, there are 4 main things that you need to look at. So just kind of going left and around clockwise here, I'll start at the top. So the closing price of the stock on the purchase date, the closing price of the stock on the offering date, and the price at which the stock is purchased, and how long that stock is actually held. So there is typically an offering period. So we'll just give an example of an offering period of 3 months. So at the offering period, when that starts, let's say the stock is trading at $10, and then what you do is you decide how much you're going to put in from a percentage standpoint into that stock. And then they will get to the end of that period and they're going to do one of two things. They're either going to buy the stock at that original $10 price at the beginning, or they're going to buy the stock at the end of the offering period, and then they apply the 15% discount. So most plans that are in place here, they actually have what is known as a look-back option. And that look-back option gives you the opportunity, if the stock actually goes up during the period of time of the offering period, you can go back and you're going to get a 15% discount at the beginning of the stock. Next, we want to remove to restricted stock units, RSUs. So these have become very common. They're very valuable because you actually have a value in that stock from day one. So with options, you need the price of the stock to go up for it to garner any value. With restricted stock, you actually have value from day one subject to vesting schedules. So company stock plans that are provided to employees as additional compensation, and usually it's considered part of your salary, and it's just given to you in the form of company stock. That stock is actually subject, when it vests, it is subject to W-2 earnings. So it's just like it hits your salary. It's going to show up on your W-2 at the end of the year as compensation. You're charged ordinary income, withholding taxes, just like Social Security, Medicare, state and local taxes. These plans are very, very common with technology and biotech companies, and then there are decision points that you have to make around restricted stock. So there's a couple things that you look at, and I'll give you kind of a typical scenario where this comes into play. So one is the grant date. And that is the date that the company, the shares of the company are pledged to you. So a lot of times, if you're just, they'll do this annually. They will give you a grant as part of your compensation package. So let's say they give you 1,000 shares on January 2nd. And then there will be a vesting period, which is the second part. So the vesting period typically is 3 or 4 years. So let's just use a 4-year vest on this. If you look at that, you granted 1,000 shares. The next January 2nd, 1 year from this date, 250 shares will vest. And each subsequent year, another 250 shares will vest. That comes to you, and then you are going to owe taxes on ordinary income on whatever the value of those shares are. There's no real way around having that hit your ordinary income. So let's talk about what happens when that decision point comes. So you were granted 1,000 shares January 2nd. The next January 2nd comes the following year, and you have 3 main options that you can employ here. So one is selling to cover the net issuance. So essentially, you're going to sell the amount of shares that are required to pay the tax on the shares that you just received. So you're going to sell the number of shares, and you're going to keep the remaining shares in a brokerage account. The second is a cash transfer. That means exactly what it sounds like. You are going to write a check for the tax burden for those shares that are going to vest, and then you will maintain all of the stock that is in that account that have invested. So if it's 250 shares, you're still going to have 250 shares after the transaction, but you're going to have to write a check for whatever the value is at your ordinary income rate. And then the last one, which is probably the most common, is the same-day sale. And essentially what you're doing is you're selling all the shares on that day of vesting. Part of it goes to pay for the tax, and the rest comes to you in the form of cash, where you can actually go and build a diversified portfolio. Restricted stock, because of their taxation and the way it works, the only way that you're going to get capital gains treatment is essentially holding that stock and then holding it for another year. So it's fully netted out from a tax perspective. So in many cases, when you're making a decision, if you need to diversify a portfolio or that level of concentration has become very high, restricted stock is a typical area where you're going to convert shares immediately to cash, and it's the most tax-efficient way to diversify a portfolio. Next, I want to talk about stock options. So there are two types of stock options you're gonna be encountering. One is a non-qualified stock option, and the other is an incentive stock options. So there are two decision points that you really have to make with stock options. The first is, when do you exercise them? So stock options come with a vesting schedule, just like you see with restricted stock, but they also come with an expiration. And the expiration is usually 10 years out from the grant date. That is 99% they expire in 10 years. So you have to make a decision on when to exercise those options somewhere along that 10-year pattern. And one way to think about it is, once you're vested in those stock options, think about every day somebody calls on you on the phone and says, "Hey, do you want to sell this? Do you want to sell this stock today for X amount of dollars? Your strike price, your grant price is $10. It's worth $20. Do you want to sell it today for $20? And then the next day they call you. You want to sell it today for $20? You have a decision that you can make every day. As that expiration comes closer to an end, there's something called time value decay. So there's some methodology that you want to look at when the leverage is at its highest, and it depends on the volatility of the stock and the price of the stock. So your first decision is, when do you want to exercise? And obviously we help people do that all the time when it comes to options. The second decision is, when do you want to sell? So those are independent, and you don't have to make the sell decision before the end of the 10 years. You just have to decide when it's best or most appropriate to sell, and that goes into taxation, all the things that we've talked about already. The differences in taxation is, non-qualified stock options are pretty straightforward in that it's just ordinary income on the difference between the strike price, which is the grant price, and the exercise price. That is ordinary income, and then you make a decision on what to do the stock from there. With incentive stock options, you can actually obtain capital gains treatment on incentive stock options. So they're not taxable when they're granted, they're not taxable when you exercise, and if you hold the shares for more than a year after exercise date, you can actually achieve capital gains tax rates or pay capital gains rates instead of ordinary income. Like we talked about a while back, it is subject to alternative minimum tax, so it's something you have to watch. But there's a lot more strategy to be employed with incentive stock options than there are with non-qualified options, but they both have those two decision points: when to exercise, when to sell. So now let's just develop a little context for informing hold and sell decisions around stocks. So kind of four things we'll talk about here, starting in the upper left, understanding the impact of the recent tax law changes on your wealth. So taxes are changing a little more often than they used to, but they're changing quite a bit, and how it really directly relates to executive compensation is around incentive stock options. So this tax law passed in 2017, and it essentially adjusted what is known as the alternative minimum tax. The alternative minimum tax is a parallel tax system, and what it's designed to do is to make sure that people who have what are known as a lot of preference items, like incentive stocks or municipal bonds, those types of things, that they have to pay some of their tax up front. The change in the tax law was as it related to alternative minimum tax. The alternative minimum tax exemptions rose quite significantly. So whereas when you would exercise incentive stock options in the past, people ran into some big problems around the alternative minimum tax, because even though you held the shares, you would own a tax based on AMT, and you didn't necessarily have the cash to pay those taxes. The real disaster story was back in the .com area, or when it became .bomb, is people would exercise incentive stock options. They would hold the stock because stocks kept rallying. They just want to hold that. They had a huge alternative minimum tax bill the next year. And then we know what happened with stocks in the 2000 through 2002 timeframe. They ended up having no value to pay those taxes. Second is watch out for concentrated wealth. As these things vest, you just have to keep your eye on whether or not you're in one of those trigger points, which is that 10 to 20% of your overall holdings coming in a single stock. And then you want to consider the tax consequences of your investment decisions. So when you are making decisions to exercise or outright sell, you want to look at what else is going on in your life. Did you sell some real estate that created a lot of capital gains? Did you sell other outside stock that created those capital gains? Are you looking to retire and exit the workforce in the next couple of years? So you may want to delay selling some of that stock so you don't trigger some of the additional taxes that have shown up. And then the last thing is really to understand what kind of investor you are, just how risk averse you are, what kind of impact does this have to your overall financial goals. So it's not a single decision point that this is what everybody does. It really relates to what kind of risk you're willing to take as an investor. So assessing the risk reward of a large single stock position. So essentially what happened, and I alluded to this early on, is there's certainly some very, very powerful stories around individual stock performance. We all know them, and particularly in Silicon Valley, there's been a lot of great stories. And I'll just pause here for a second to say, even if you are diversifying away from a position, you're still rooting for your stock. So you still want it to go up, but you just want to start piecing off some of those dollars and apply them to your goals, so you put more certainty. So a large single stock position, it just has a substandard risk reward profile. As I said before, it's about 30% more volatile than a broad-based portfolio, and the actual median return is a little bit less. And I'll pause there too and say the other aspect of this is you have a wide variance of returns. So you have the superstars that, has a lot of people saying, "Oh, regret, I wish I hadn't sold any of this stock." But equally, you have the other side of stocks that have really plummeted and people miss their opportunity to really set themselves up for the long haul. So you've got to assess that risk reward of a large single stock position. You've got to look at the company directly and apply it to the risk reward of your own personal situation and your family. So let's talk about some of the strategies for managing your single stock position. So first, and these are very, very tactical. We've used these with a lot of clients, and I will start by saying there's only 4 things you can do with your money. All right? You can spend it, you can give it to your kids, you can give it to charity, or you can give it to the government. Those are essentially the 4 places that money ends up. So when you're doing the planning and you're sitting down and going through what your goals are, you decide which of those 4 are most important to you and prioritize those things. And then you want to make sure that single stock concentration and candidly, the entirety of your estate has both an effective and efficient distribution to those areas. So effective means it gets where you want it to go: charity, spend, kids, taxes. Efficient means you do it in the most efficient way from a tax perspective. And that's where the detail comes in on some of these strategies. So let's start with selling a concentrated position using the charitable remainder trust. Let's just say you have $1 million in the stock. There's a couple different options that you have as it relates to charitable remainder trust. You can sell the stock at $1 million. Your tax rate, California, 45%. All in. So you have $550,000 that you're left with. You go make investments, and it produces cash flow for the long haul, grows, et cetera, et cetera. Another option that you have is actually to transfer the stock into a charitable remainder trust if you have charitable intent. So instead of having $550,000 to work with, you actually have the entire $1 million to work with. So you transfer the stock before selling it into a charitable remainder trust. Now you have $1 million working. The remainder of that $1 million as it grows goes to the charity of choice. For that, you get a current income tax deduction. In the meantime, whether it's a 20-year period or you can actually set it up where it's a lifetime, your lifetime, a lifetime of you and a partner, you can receive income from that. So you are receiving income every year based on the higher dollar amount. You receive a tax deduction, and the remainder goes to a charity of your choice. So it's a very effective way to get money out of your estate if you have an estate tax problem, generate income for long periods of time, and then get a tax deduction up front so you help in the current sense. So a couple of nuances here on this. There's also something called a net income makeup charitable remainder trust. So if you are working for another 3 years, say, you do not have to turn on the income of that charitable remainder trust in the years where your tax bracket is astronomical. But once you retire, you can start taking that income that you didn't take while you were working. So it helps you actually supercharge the income. In a lot of cases, you're actually generating more cash flow than if you just sold the stock and created the income. So charitable remainder trusts and variations of that are one of the strategies. Many of you probably have heard of this, a donor-advised fund. One thing you can do is take appreciated stock, put it into a donor-advised fund. You get the charitable deduction up front, and then that donor advisor fund, you can direct charities that you want to support over a number of years. So get the tax deduction up front and support charities over time. So people will do that with appreciated stock instead of selling the stock now, putting it in a donor advised fund later. Structured stock selling. So a couple different forms that this would take. If you have stock and you're still working, there are a lot of people that are still considered insiders, which means there are blackout periods. There are times when you cannot sell the stock. So it makes it more difficult to diversify because you have very small windows. We were talking with a client just the other day trying to do this. The window is literally a 3-week window when they can sell out of each quarter. So it can be very limiting. There are ways around that called the 10b5-1 plan, where you can actually do structured selling throughout black periods as long as you make that election prior in a non-blackout period and you don't go and amend those elections. So there's some structured selling that can be done within the plan itself, and you set up with the firm that actually holds the stock at your company. You submit some forms called the 10b5-1 form, and it allows you to diversify effectively. Exchange funds, this is essentially where you are pledging your shares of concentrated stock into a fund where other, say 10 or 20 other employees of different firms have also pledged. So you're taking a single concentrated position and you're getting a diversified portfolio of 20 other companies or 30 other companies. And there are some managers that look and create a risk return profile. So you don't have the taxation of selling, you're deferring that taxation, but you get diversification. So it's an effective way to get diversification away from a stock without creating a tax burden. Stock protection plans, rarely used, but it's important just to kind of clean the slate on this. It's where you put assets into a commingled fund with other folks, and it comes in the form of stock. They sell it, invest in treasury bills or something that's very safe. The fees are 2% up front and 2% a year. And essentially, if your stock does very poorly, you're going to benefit from making this move. If your stock does very well, you're not going to benefit from that. But essentially, it's just a diversification strategy around taking the risk out of your stock having one of the extremely negative outcomes. But it's a little bit expensive to do. And then using options for value protection. So a lot of times these are shorter term strategies where you may buy a put option. So it puts a floor on the value of the stock if it falls dramatically. If you own shares outright and your plan allows it, you can also use options as an exit strategy where you can create income from your existing position. Instead of just selling outright, you can create income by selling calls, which creates an income stream, and you're actually okay with the company being called away from you. It limits the upside, but it also gives you a little bit of protection from an income standpoint. What I would say about options strategies is if they're not really very useful for doing it over extended periods of time. They're usually short-term protection devices. So giving stock to family. So essentially, this is exactly what it sounds like. If you're not utilizing the asset, you can give the stock to a family, and they take on the cost basis of the stock. So you do some gifting. You can use your lifetime exemption from an estate planning standpoint, which right now is north of $22 million as a family, over just about $11.5 million. For an individual. You can use some of that lifetime value, gift it. The family member takes the cost basis. They may be in a lower bracket, but it's really an estate planning strategy to get assets out of your estate and potentially get a lower tax bracket for children if you're giving it to a family member. And then there's donating concentrated stock to a private foundation. So charitable remainder trust in the upper left that we talked about creates an income. The private foundation, you're essentially just creating you're donating stock, not paying tax, you're getting an income tax deduction, and you've created a foundation that can actually be evergreen and donate to charities of your family's choice, create boards of directors to decide how to utilize those assets. You're essentially getting money out of your estate, but it's for charitable people who are really charitably inclined and maybe want to give a purpose to future generations of family members to manage that charity and also donate to causes that are important to them. So there's a lot of things a lot of strategies that you need to implement or that you can implement, but you want to pay attention to taxation. How does it fit to your overall goals? And then what are your intentions on the places you want to go? You want to spend it, you want to give it to charity, you want to give it to your kids, or do you want to give it to the government?